Good afternoon and welcome to this afternoon's webinar. My name is Simon Smith and I'm Head of Research here at FX Pro. This webinar is really designed for those of you completely new to the world of Forex, and I hope to give you a basic understanding of what Forex is and also an introduction to the market and the terminology. Next week I'll follow up with one on trading, and also on the Tuesday and also on Thursday doing one on the psychology of trading as well. Of course, within 30 minutes, I can't tell you everything, and I guess the thing about trading and Forex trading, the same as anything, is that you're always learning. And if you think you know everything, I think you're doomed to fail. Just make you aware of the disclaimer. I'm not going to read the whole thing, but just to say that this is a marketing communication and should not be considered investment advice, and also that the risk warning, which essentially says that CFDs are leveraged products and include a high level of risk, and you should seek independent advice if necessary. You will see as part of the webinar software there is the ability to ask questions. So from the top of the webinar software, you should see a pop-down panel. There's a Q&A tab within there, so you can ask questions through that, and if during the webinar you can keep it related to the content I've presented, so we can maintain the flow and keep things on topic. And all questions in the Q&A will only be seen by me, and even though it will be recorded, I won't refer to anyone by name and will answer questions anonymously. So let's just run through what we are going to be looking at today. Firstly, just understand what we mean by Forex, just a really sort of simple introduction. Then move on to see why the market has grown strongly in recent years and some of the forces behind that. Also, like anything, Forex is scattered with terminology, so we will be walking through some of that, and we'll be doing some more next week in the trading seminar, but just certainly want to get you involved in some of the simple terminology, and then get you a feeling for the dynamics of Forex markets. Maybe you're familiar with equities and bonds, just to give you a feeling of how Forex markets are different and the main features to watch out for. And then at the end, just give you an idea of the next steps to be taken and thinking about once this webinar is over, which should last about 25 minutes, leaving 5 minutes for questions at the end. So you might see this oft-quoted figure that FX markets have turnover around sort of $5 trillion a day. And around 40% is spot FX. So spot is when you are doing a transaction dated for now, essentially, or usually spot is 2 days later. So that's just under 40% of volume, but there are other FX products out there, such as swaps and forwards and derivatives such as options as well, which structures which derive their value from the underlying market. In terms of the way the retail market is growing, it's not as easy to get figures, but there's certainly, most of the figures suggest it's growing faster than the broader market. A lot of those trades may not get passed through to the market, but you have to remember that as an agency broker, all our trades are passed to the market and banks, and market makers won't. So getting real numbers on the retail is hard to do, but certainly it's been growing fairly strongly over recent years. So let's really strip things back to the basics. Now, it may seem a bit simple and at this point, but bear with me and it'll make sense in the next 1 to 2 minutes. So of course, in the early days before money, let's say we have our notional caveman here, we were sort of in a barter economy, weren't we, where we'd exchange goods. So in this one, exchanging 2 foodstuffs, sausages for vegetables by the looks of it. But when you're doing that, you swap or barter, you should be no worse or better off when doing that. So you're receiving something you think was equally worth what you're giving away. So that's essentially what any trade is about. Let's move forward, missing out a few stages, where we have money. So rather than carry around a barter economy, which can be difficult to divide up things and also difficult to carry around lots of goods, and you can have money. So essentially replacing one of those with money. We missed out the part about gold and commodities, etc. So I'm trying to keep this simple. And it's not a great leap of faith to then go to look at where we do the same. So any transaction where both sides are thinking that it's an equally worthwhile thing to be doing, as I was saying. So we're still doing an exchange, just as we were right at the beginning in the 2 slides ago. Forex is a similar type of transaction, you're just exchanging different currencies. But actually, in these examples, you don't actually see the goods. So on the left-hand side, our chap here is selling euros. So he's selling €1 to the chap on the right, and he's receiving in return an amount of dollars, which is 1.3015. The great thing about money is that it's nearly infinitely divisible, so you can divide it up very easily. So I think the bottom line is that we're just simply exchanging different currencies, and just as the same, we're exchanging different goods right at the beginning and exchanging goods for money in the little bit we did there. I'm going to come back to this point as well, but just to really showing, so it's foreign exchange. You are exchanging foreign currency, and that's at one level as simple as it is. So foreign exchange rate is simply the rate at which you exchange one currency for another. The one quoted on the left hand side, so here we have EUR USD, so currency codes are always quoted with 3-letter codes, let's say. The one on the left hand side is the base one, so the 1 unit of, so we had that in our previous slide, didn't we, where we're exchanging €1, so the 1 unit for on the right, so we call that the base currency. If we split this down more, and usually there are exceptions. Usually the first 2 letters of the country code for that. So US is for USD, or the United States in terms of, and the D is for the dollar. Like I said, everything doesn't hold. So the euro is the exception to that, where you have the EUR code. But I guess the eurozone isn't a country, and some would say it isn't a proper currency. But that's something to talk about at another time. Another bit of terminology just worth saying is that when we talk about euro dollar or buying euro dollar, euro stronger, so that means that the euro dollar exchange rate is going up. So if we see euro dollar move higher, it's the euro that's moving higher and the dollar that's weakening. It's just as much saying about, and I'm going to say this point quite a few times, it's a currency pair. So what happens in this currency pair is telling you just as much about what's happening to the dollar as it is about what's happening to the euro. So yes, if this moves higher from 13015 to 132, for example, the euro is stronger, but also just as equally the dollar is weaker. And the opposite holds true. So if we see euro dollar moving lower, so say we went down to 1.2900, that's the euro weaker and the dollar stronger. Again, I make the point that it's currency pairs. So it's just as equally saying that the dollar is strengthening as the euro weakening. Let's just touch on the growth of the Forex market. This is something I put together. It doesn't have the sort of 2013 numbers. I think I did it for a presentation a couple of years ago. But you can see the world economy has been generally growing, and I've just, to keep things simple, I rebased these numbers back into 1989. So if something is from just 1 to 2, the volume is essentially doubling. So you can see that the global economy in green has been expanding generally over this time. You can see that global trade has been expanding even further. So we are trading as a world more and more with overseas countries. So that naturally requires an exchange of foreign currencies in relation to the other. So you can understand why foreign exchange would have increased because of this bigger growth in world trade. But you can see within that, foreign exchange has outstripped the turnover, even that which is seen both in world trade and also global trade. So you can see what's called a pretty strong growth in FX over recent years. And it was the point to make that it's even when we had the financial crisis and we saw trading in a lot of different markets, so equities, bonds, commodities, we saw volumes falling, but in FX it's pretty much kept rising regardless. It's another point to make that even despite the financial crisis, volumes in FX have continued to rise. And again, just to make the point that this is all rebased, so don't worry about the figures on the left hand side, it's just the rates of growth comparative that we're interested in. And that's because foreign exchange sort of increases as an investment class, but I'm just going to talk about that towards the end of the presentation. I want to just introduce you to Forex terminology. I'll be doing more of this next week on Tuesday, and I'll make the point about the webinars later on. So on Tuesday and Thursday of next week, we'll be talking more about this. But it's important to bring you some of the terminology because, as with anything, there is a lot of it. So lots. Lots is a way of measuring the quantity. So with 100,000 is one lot. And we always talk about that in relation to the base currency. And going back to euro dollar, that is in relation to euros. So you'll see that on the trading platform in terms of when you want to buy and sell. You'll see one lot and divisions thereof. Well, normally it goes down to 0.01 lot, so 10,000 units of the base currency. But for EA trading accounts on MT4, we actually go down even smaller, so we can deal with the money management EAs, which go down to 0.01 lots. So all this relates to units of the base currency. Leverage is an important aspect of foreign exchange. If you wanted to open a 0.1 of lots, so 10,000 of euros would be needed. That's a lot, isn't it? But leverage means you don't have to stump up that whole amount. So leverage of 1 to 50 to open a 10,000 euro position. With leverage of 1 to 50, you'd require 500 euros. So that's known as the margin. So they're inverses of each other. It's a very important point to note with FX because it is a leveraged product. You can trade with one-to-one leverage, but leverage allows you naturally to multiply gains and just as equally multiply losses, and which why, as I will talk about later, risk management becomes very important. You'll hear about pips, which is the smallest standard price change in the currency. Now, I've stuck with this quote that I had on our earlier screen for euro dollar. It's done presentations time ago, so we're not trading around there at the moment. We're just trading, I haven't got my screen right in front of me, just below 134 when I last looked. But it's usually the smallest. So on most currency pairs, a pip is to 4 decimal places. On ones like dollar yen, on the majors, it's to the 2 decimal places. So we talk about pips in terms of movement. So a move from 1.3015 to 1.3016 would be a 1 pip move. Same for sterling USD and Aussie dollar, etc. So most of them are to 4 decimal places. So that's an important point to make as well about pips, and that's another piece of terminology you'll hear about often. So people will say, I made 20 pips or whatever on a currency pair. So that's what they're talking about, the smallest standard unit of price change. But as I say, there is a smaller decimal point because of the tight spreads that come about, so just to be aware of that as well. And finally, just for this sort of terminology overload, just to point out about spreads as well. Spread is simply the difference between the bid and ask prices that you see here quoted in pips. So here, 3.015, so 15 to 16, so 159 to 163. You've got a spread of less than 1 pip, so it's 0.4, so it's the 1.6. Sorry, the 63 minus 59, so that's 0.4. So you can see very narrow spreads on this. This is taken from our CTrader platform. The spreads are usually actually tighter than that, and certainly quite often zero inverted at the moment as well. So again, this was just taken some time ago. But again, that's a fourth piece of terminology for this side to just keep you, and that's important because, as I said before and early on, FX in general is a very liquid market. We use over 10 liquidity providers, I think, currently. So that means that the difference between the buy and sell side prices are very narrow, and that means it's easy to get in and out without paying the spread a lot, so you can trade more frequently without losing as much on the spread, which is a bit of a generalization, but that's a point in why spreads are important. So just going back to more terminology, and I know this feels like a bit of a terminology overload, but I think it's important in this first webinar, and we're sort of building it in the second and thirds just to get used to it, because I think we people that are used to Forex take this for granted, but I think those new to it, I think it's good to have a grounding so you are comfortable with it. So say when you're going long euro dollar, just to make the point, we're always talking about that base currency. So we're going long euro, we're buying euro and selling dollar, and this moves on to the point I'll be making in terms of the way it relates to other markets now. And just again, exactly the opposite. So when you're going short euro dollar, you are essentially selling euros and buying dollars. I make that point because let's look at FX in relation to other markets. I just simply, for choice, took equities. I took the main 3 indices in the US, the S&P 500, the Nikkei in Japan, and the Euro Stoxx 50 in Europe. You can see generally, most of the time, the stock markets will move in the same direction. The caveat to that point is they don't move at the same pace. So you can obviously see in this early period, they were moving pretty much in tandem. You saw then the S&P outperforming, but within that, Japan or the Euro Stoxx underperforming Japan as well. So you can see generally the directional is the same, but the pace of those moves. And obviously here we had a big move on the Nikkei as Abenomics kicked in. We had quantitative easing and all these other things that happened from the change in government. But generally, markets are correlated, and stock markets you can see are correlated here. So you can clearly switch between markets, but there is certainly an underlying pattern to that. The point is that generally markets do move in the same direction, again with making the point that the pace of those moves will be different. As you see here, again, the more moving in the same direction, Euro Stoxx very weakly so, Japan very strongly so, S&P in the middle. You very rarely you do sometimes get those periods where they'll diverge, but it's relatively rare where you'll get the US moving higher, Europe moving lower. There are little periods in here, but it's harder to do in this globalized world. The other important point to make from that is that you also get an income from equity markets and bonds as well. So you're getting that flow from your investment. So in general, inflation and economic growth will push equities higher. Of course, there's a big caveat to that. There'll be bumps along the way, of course, and sometimes they can be quite big bumps. Let's make the point that you can only price a currency in relation to another currency. So yes, where we're seeing equities will generally rise over the longer term, again, that's a very broad statement. That's a general belief. That can't always happen to currencies. All currencies can't rise in relation to each other because you have to price them in relation to each other. As you saw, euro dollar, when euro dollar goes higher, it's telling you just as much about a stronger euro as it's telling you about a weaker dollar. So making that point in a different way, so a bear market for the dollar is a bull market for the euro, and vice versa. And making the point again that all currencies cannot depreciate against each other, and it's having a strange one of the chat rooms I'm in even early this week, and people make this mistake so often as asking someone's views on currencies when they say, well, I'm bearish the euro, I'm bearish the dollar, and I'm not that much of a fan of the yen. Okay, but they can't all move down against each other. If generally the case, something has to go up. And I think people miss that point quite a lot with currencies. You can't be bearish on everything. And one currency cannot fall forever versus another. There's the bigger term is sort of mean reversion element, and you'll see what I mean in this next chart. So I just took for choice in Australia. So I took the stock exchange and I took the currency, looking in very, very broad, big picture terms, but you can Squeeze this down, you can see the stock exchange generally on a rising trend. The pace of that has differed, and you've seen corrections lower as you did in around sort of 2001, 2002, but generally an upward trend here, getting stronger as a sort of Australia was more aligning to China and the growth we saw in China. Aussie dollar, this is I think a trade weighted index that I used here. Generally, or no, it wasn't actually, probably Aussie dollar itself, but generally a more sort of stationary series, if you want to use the technical term. So it's not trending higher. There are bigger trends within this, the downward trend and the upward trend there, but you can see in generally you're seeing a flatter trend. So currencies will not be as trended as you see in equities or perhaps bonds, and it's certainly the big bull market in bonds you've seen the last 30 years. So it makes the point again in a different way that I made in the slide before, that you cannot see currency sort of depreciate versus another one forever and ever. There'll be a sort of mean reversion element that you see here. So you see a pull down, but you then see it revert back. So where are we now? We're 22 minutes into the webinar, so I've done it a bit quicker, but I'm probably just going to be bang on my 25 minutes when I've just been through the next points. As I said, there's next webinar. You can go to the webinars page on our website. You will see that available from the front page on the tabs, and you can see a list of our next webinars coming up. So we have one on Friday, building a trading strategy with quant, and the ones I've talked about, so the introduction to forex trading on Tuesday and the psychology of trading on the Thursday. Look at some past webinars. You can do that on the previous webinars tab here, which uses the WebEx software, but we're also trying to build up a library on our YouTube channel. So if you search FX Pro or FX Pro Marketing on YouTube, we're building up a library of webinars on there as well, and all being well, we should be putting this one up there in the next day or so. There's a FX Pro Trading Academy page where on our website, so you can go into that from the front page. You can see videos and guides within that. We're adding to that all the time. We're actually building out quite a substantial new version of that as we speak, which we're working on and should be launched in the nearest future. That'll be a big resource as well for you. But as I said right at the beginning, trading is all about learning. There isn't sort of a rule book you can follow that's going to mean you can master trading in a very short space of time. It's all about reading and learning, and I can recommend, there are books that I do have found useful, but I can't necessarily recommend them here. But certainly looking around on the usual sites for reviews, forums and elsewhere, you can find many different ways of trading. And as I say in the trading psychology section and the webinars on Tuesday and Thursday, what's most important is you find a way of approaching trading and the markets that suits your style and your mentality and your approach to risk. Because if you try and do something that doesn't fit with you'll be fighting yourself along the way, all along the way. So I hope now that we've done this webinar, you can really have the basic understanding of Forex nailed, and making the point that you're simply pricing one currency in terms of another. And you can understand why Forex market has grown strongly in recent years, and some of the simple reasons behind that. You can understand, hopefully, giving you a briefing on the terminology of Forex markets. Everything has its weird terminology, so I've brought some of that in. I'll bring some more in Tuesday and Thursday of next week in the subsequent webinars. But I think most importantly, you can see why Forex can potentially act as a diversification tool in a more wider strategy, and why people are attracted to Forex simply for the fact that they behave differently to equities and also bonds, and also by the simple fact I made earlier that all currencies can't go down versus all the time. So you'll see in the financial crisis, there are currencies that did badly. If you go back to 2008, the Aussie dollar being one of them, but equally their currency did very well, the US dollar. So there's always somewhere a currency going down, but also the fact that you can just as equally make money from falling markets as you can from rising markets, and making that same point in a different way. And hopefully I've just made you aware of the next steps that you can take along the way, as well as our webinars Tuesday and Thursday next week. We have the resources available on the website and on our YouTube page as well. So now is the time. If you'd like to ask questions, you can do so in the Q&A window. As I said before, these questions are anonymous. I will answer them verbally and won't refer to anyone by name. There's one, not so much a question, but a comment. So I am not new to FX, but the presentation was original. Thank you. Yes, no, I didn't copy it off the internet. I can vouch for that. I did make it up myself. Oh, someone else has asked, can I try trading on a practice account? Of course you can. You can download demo accounts of MT4 and CTrader, and the most important thing is, I guess, before you just open a practice account and click buy and sell, I think it's useful to have it there, but before you sort of jump in, is to gain an understanding of FX through this webinar and through other webinars and resources, to build on that understanding and then dip into it. So quite often people will jump even on a demo account, but even before you start demo trading, have an idea of why you're trading and your approach and how to manage risk, because if you just sort of jump straight in 2 feet, you will invariably fail. And this is what this webinar is about, and the webinars we are doing as well. Someone's asking why the spread on CTrader is much lower than on MT4. Good question. Simple answer. CTrader, you're charged a commission on trades. On MT4, we put a markup on the spread. So CTrader, the spreads you saw or the prices you see are essentially streamed straight from our pool of liquidity providers. So yes, they are tighter, and we charge a commission on those trades. On MT4, we apply a markup to the spread, so it's just a different way of us as a company. As I said, as you know, we are an agency broker, so we pass all our trades through to the market. We're not taking proprietary risk. We're not running a B book, so we're not essentially making money from losing trades. That's another important point to make, and you can see explanations of that on our website and YouTube page as well. So we simply make money from CTrader, from the commission, or MT4, the spread on trades, never from your losses. So a follow-up question. So CTrader is for more serious traders with larger amounts of money. Not necessarily. It depends on your approach to trading. I guess, again, isn't just as my view, it's my personal view. I guess in some ways you could say CTrader is if you're taking a more, let's say, non-quantitative view and of markets and wanted to trade more, let's say as a sort of pure trader, you might find CTrader better. But MT4 has a huge amount of resources behind it in terms of expert advisors. You can still do those on CTrader as well, but the program language is different. They're not easily convertible. We're working on that over the coming months to make that more accessible. So it's just with MT4 is just light because it's well known and there's a lot of resources around it. So that's just the point worth making. So I wouldn't necessarily say that it's for serious traders with larger amounts of money, but it all boils down to a matter of choice, really, at the end of the day. And you can obviously there are those that are wedded to MT4 and really like it. There are others that find it a bit clunky and much prefer to have something different, and that's why CTrader is available. Well, that's great. We're up of our time. Thank you very much for your questions. And as I said, go to the webinars page, and also you can see after this webinar there should be a simple 2-question questionnaire which asks you for your feedback and any suggestions on future webinars. If you could fill that in, it's always much appreciated. So thank you very much for your time.